Most retirees focus on the same big question: how much can I safely take out of my retirement accounts each year? But once the IRS required minimum distributions begin, another question shows up, and one that almost no one prepares for. What do you do when the IRS forces you to take money you don't actually need? You may already have your lifestyle covered by Social Security, pensions, rental income, or other sources. Your spending may be stable, and your retirement plan may be well structured. But the IRS doesn't ask whether you need the income. They simply require the withdrawal and want their share of your tax-deferred market growth that has taken place over the years. And suddenly, retirees find themselves facing additional taxable income they didn't plan for, which can mean higher Medicare premiums, more of their Social Security becoming taxable, and a growing taxable account they don't necessarily want, all because the RMD arrived on schedule, whether it fit their plan or not. I meet many retirees who say the same thing. Hank, I don't mind taking the distribution, I just don't know what to do with it once it comes out. And that's a fair question because unwanted RMDs can quietly erode your tax efficiency unless you redirect them intentionally. That's what we're going to walk through today. Hi, I'm Hank Persia, President and owner of Starboard Wealth Advisors. I help retirees and pre-retirees design tax-efficient income strategies that support their lifestyle and protect their long-term plan from unnecessary tax exposure. If you're approaching RMD age or if you're already taking your withdrawals, understanding how to use RMDs you don't need may make a meaningful difference in your tax picture, your future flexibility, and your legacy. Today, we're breaking down 4 smart ways to use your RMDs even if you don't need the income. Let's get into it. Strategy number 1, reinvest the RMD in a tax-efficient way. You can't avoid taking an RMD, but you can control what happens after the cash hits your bank account. For many retirees, the simplest and most flexible strategy is to reinvest the RMD in a taxable brokerage account, but in a tax-efficient manner. Some effective approaches include using tax-efficient exchange-traded funds, or ETFs, since many broad ETFs are designed to limit capital gains distribution, which can help reduce any ongoing tax drag. Second, building a diversified, low-turnover stock portfolio that can still generate growth, but with fewer annual capital gains, which keeps your tax burden more predictable. Third, considering municipal individual bonds or bond funds, since depending upon your tax bracket and where you live, municipal bond income is often federally tax exempt and sometimes state tax exempt as well. And fourth, pairing your RMD investment with a long-term goal, since some retirees reinvest RMDs with the intention of leaving the account to their heirs. You see, a taxable account often receives a step-up in basis when the account owner dies, which may eliminate much of the embedded capital gains when your children inherit the account. This strategy works well for retirees who want market growth, liquidity, simplicity, and a flexible pool of assets for future needs. It's straightforward, fits most financial plans, and keeps the RMD productive rather than idle. Strategy 2, use the RMD to fund Roth conversions if eligible. Here's a strategy many retirees don't realize is possible. Your RMD cannot go directly into a Roth IRA, but once it's withdrawn, it becomes cash like anything else. And if you or your spouse have earned income, you may be able to contribute to a Roth IRA. This can offer tax-free growth, tax-free withdrawals, no RMDs in the future, and a potential tax-free inheritance for your children. For married couples, this can be especially useful when one spouse may be retired and taking RMDs, while the other spouse is still earning income, because you can use the RMD to fund a spousal Roth IRA or your own Roth IRA if you still have earnings. This is a clean way to turn taxable required income into future tax-free income and add long-term flexibility to your retirement plan. Strategy 3, reduce future RMDs with strategic Roth conversions even after RMD age. Many retirees assume that once RMDs begin, Roth conversions are no longer an option. That's not the case. You cannot convert your RMD amount, the IRS prohibits that, but you can still convert any additional traditional IRA or 401k dollars above and beyond your RMD. For retirees who don't need the RMDs, this may be one of the most effective long-term tax strategies, because Roth conversions may help reduce future RMDs and thereby lower your lifetime tax liability, protect a surviving spouse from higher future brackets, reduce potential Medicare IRMA surcharges, decrease future Social Security taxation, and create a tax-free assets for your heirs. The key is this conversion must be intentional and not random. Remember, you will still have to pay tax on the amount converted, so you should evaluate the long-term benefit of this approach. You'll want to manage your tax bracket, understand how the conversion fits into your long-term plan, and avoid pushing yourself into a higher tax tier unless it makes strategic sense. Even in your early to mid-70s, conversions may remain a meaningful planning tool, especially if you don't need your RMD income. Strategy 4. Use Qualified Charitable Distributions, or QCDs. If charitable giving is part of your values or long-term wishes, this strategy may be the most tax efficient of all. In 2025, a Qualified Charitable Distribution, or QCD, allows you to send up to $108,000 per year directly from your IRA to a qualified charity, and projected to be $111,000 in 2026. And here's the powerful part. QCDs satisfy your RMD, do not require you to itemize deductions on your taxes, and do not show up as taxable income, which could therefore reduce your Medicare premiums and reduce the taxable portion of your Social Security. The money never touches your tax return. It goes straight from the institution where your IRA is held to the charity or charities of your choice, whether your church, local organizations, kids' schools, etc. For retirees who already give or plan to give, this strategy may offer the cleanest path for reducing your taxes, lowering the long-term negative impact of RMDs, and most importantly, making a difference in the lives of others by giving back. Here's a bonus strategy. Use unwanted RMDs to support tax-free legacy planning. This isn't right for everyone, but for some retirees, using unwanted RMDs to fund life insurance may be a powerful way to support a future legacy. Life insurance proceeds generally pass down income tax-free. This may be helpful if your children inherit traditional IRAs, 401ks, or other taxable retirement accounts where the assets could create a future tax obligation. Using a portion of your RMD to fund a life insurance policy may help reframe taxable assets into tax-free future benefits, depending upon your health goals and overall plan. Again, this is not a universal strategy, but for certain legacy-focused households, it can be a meaningful option to evaluate. So let's recap. What can you do with your RMDs you don't need? First, reinvest the RMD tax efficiently in a brokerage account. Second, use the funds to support Roth contributions when eligible. Third, reduce future RMDs with strategic Roth conversions. Fourth, use qualified charitable distributions to lower your taxable income. And fifth, for some households, use the RMDs to buy life insurance to support tax-efficient legacy planning. You can't avoid taking your RMDs, but with the right plan, you can absolutely control what they become, whether it's long-term investment growth, a future tax-free bucket, strategic conversions, or charitable impact. The key is putting the money to work intentionally, not reactively. Thanks for watching, and remember, RMDs aren't just a tax requirement, they're an opportunity to strengthen your plan, reduce long-term taxes, and support the future you care about. If you want to understand how these strategies may apply to your situation, book a complimentary time with me using the link below. I'd be glad to take the time to walk through the options and help you think through what may make the most sense for your family's long-term plan. Remember, at Starboard Wealth Advisors, your financial destination is why we're here. Thanks for watching, and if you found this helpful, make sure to watch our other videos for more clear, no-fluff retirement guidance, or contact us for a simple phone or Zoom call. We look forward to seeing you on our next video or talking with you soon.